Hi, this is CF Liu. Now in today's lesson, I want to really educate you on what generally the big five types of business to invest in. Right, we are talking about companies, business, stock market over here. So the first type of business to invest in, now this is regardless of whether I'm not talking about whatever sector to invest in, whether it's like garments, consumer goods, REITs, real estate investment trust, whether it's services, whether it's technology. I'm not talking about that because there are multiple categories of that, but in general, from very high level, there are only 5 types of business to invest in, and type number one is what we call as the sprinter kind of business. Now, what is the sprinter type? Now, sprint, what is sprint? Sprint, it is like your Usain Bolt, right? The fastest man in the world at the time of this recording, the sprinter. We are talking about like Usain Bolt. He's running like 100 meters kind of sprint, so it's like a sprint, right? The sprinter type of business. Now when it comes to investing, when it comes to business, what the sprinter type of business meaning that they are fast, that they are fast. And when it comes to businesses, we are talking about a revenue growth, right? A revenue growth of probably much more, at least a minimum of 15% per year. Now that is kind of growth. So what I say about revenue, and when I say about revenue, I'm really talking about gross revenue over here. Gross revenue, okay, gross revenue. Now why don't we actually say that, well, what if we talk about net profit or net revenue? Now here's the thing, a net profit or a net revenue for a business is basically revenue, the gross revenue minus deduct by the expenses, right? So it is a very misleading if we were to just say that, look, the business net profit is growing. Now without actually digging further, and we say that the business is growing, is because sometimes from accounting standpoint, their net profit can actually grow very fantastic when they do what we call as the cut their bottom line. Okay, if you get what I mean, cut the bottom line. So for example, if they actually reduce their cost, or even for those a lot of major what we call as in corporate, we call it a VSS or retrenchment. So if they cut like half of their staff, just like Thanos actually snap a finger and half of the staff of the company, worker or employee is just gone, that is very easily you can see that they can achieve a very good better net profit. Business is because they cut their expenses, especially the staff costs, by a half. But that is not a true reflection of the business growth. A true reflection of a business growth always come from their top line, or their sales or business revenue, right? The top line. So we always want to look at, and when we look at the revenue, the gross revenue or gross profit, that is basically unaffected or unpolluted by whatever bottom line cost cutting in the business. And the thing is about this net profit growth, that by cutting their costs and doing like mass retrenchment just to make the numbers look good, and that is really not the sustainable way to actually grow your business, which a lot of companies are doing because the management or the CEO just want to look good. Like in this quarter, I just want to look good. Who cares about what happened 2 years from now, right? So that's why they just want the numbers to be good, so that they hit their numbers and then they get a big bonus. So a lot of business are aiming on the short term, but that short term, this kind of thing, cost cutting, bottom line cutting, is not sustainable and is also one-off. And the other thing about this sprinter kind of business is that sometimes the capital expenditure might be very huge, right? Because you always need to reinvest for growth. Business need to reinvest for business growth. So sometimes this kind of business, you could see that yes, there is growth, but the money generated will reinvest back in the business. So this business, normally they will give you very good capital gain in terms of the stock price. Capital gain. Why? because of the lack of cash flow in the business, where cash flow is used to reinvest into the business, so they have very less money to actually distribute dividend. So if you want to look for dividend yielding stocks or company or investment, the sprinter type of business is normally not your first pick, because it all banks on capital gain, right, on the stocks price going up, because you know there's high growth, so they expect it to make more and more money. One good example is Apple. Apple used to be not giving any dividend, although even though they have cash, because even though they do not reinvest much, cannot afford to actually. They actually have so much cash that they are actually buying companies every single week, according to a news article that I read, right? But even that, their cash they are still a cash cow. But even that, they don't give any significant dividends. But their growth was a growth story, because they kind of can increase their revenue every quarter over quarter, although historically that is what Apple has been doing. But you know that as of 2019 or whatnot, the smartphone markets were saturated, the device and all that, and you know that the growth, even now at the time of this recording, the growth has been slowing. So that being said, when it comes to this investment that is the sprinter type, you depends on a lot of, most of the time, on the capital gain, because the capital gain is tied to the growth expectation of them growing more and more and more. So they are very vulnerable when it comes to the business or the revenue every quarter, this quarter or this year is not meeting analyst expectation, right? So they are very vulnerable of those share price actually go down and plummet, because the growth story has stalled or has slowed or has stopped. So that is the one thing you have to be careful about. Now, after a company has experienced this kind of sprinter company, experience this kind of growth, for example, Apple, what is the next stage they're evolving in? Actually, they evolve over here, and they evolve into the second type of company, what I call is the resilient. Now, the resilient, taking also still Apple as an example, you know that the resilient, they have a huge market share to a point that sometimes you can call is a huge monopoly, or also they say they have a huge market share. At least there is good branding. So people know them. People actually, they are a bit, the consumer a bit of a loyalist. For example, Nestle, their product Milo is another one, because Milo, Ovaltine and all that is just not that popular, right? People just want Milo. So the resilient company, they have from the fast grower or the sprinter, they would have settled into what we call as a resilient company, whereby the growth, right? The growth is still there, okay? The growth is still there, but it could be, 5 or even still to 15% or whatnot per year. There is still a growth story, but it just isn't as fast as it used to be, right? And when your company has just passed this kind of resilient, has just categorized this resilient kind of company or stock, you know that they also have the ability to pass, the cost to consumer. So they are not, in other words, they are the not price taker. So again, another good example is that, if they say that raw material for a Milo, which is cocoa basically, and it increased, let's say, by 10%, and if Milo next month costs 10% more, and people are still going to buy that, right? Just going to grumble and complain and all that, but generally they are still going to buy Milo. Similarly, when it comes to this kind of company with brand like Apple, right? There are this Apple, they have their hardcore fans, okay? Or even if you are not a hardcore fans, you know that it is very troublesome to actually change from this so-called an iOS ecosystem to something else, to Android, for example. So people are just going to stick there, and if their phone breaks, they are still going to buy another Apple phone, which would probably cost more expensive than the device they already have, right? We call it upgrade or replacement. So they are basically not price taker. They can pass the price increase of the cost to consumer. So that is the beauty of those resilient business. Like I say, they have a lower trajectory for growth, and whereas Apple and all that, they are devices, premium devices. When it comes to F&B like Nestle, some of their products or most of the products are actually a necessity, always in demand, regardless. Like for example, Milo, if recession comes, it's likely you're not going to cut down. You are going to cut down on everything, your discretionary spending, your travel, but you're not going to cut down on Milo. Even though the price increase during recession, you can afford it, you still support and drink, because this is something that like a necessity, always in demand, right? And to an extent, I would say that this is sometimes probably recession proof, this kind of business or stock. So the resilient stocks or counters or businesses are something to really have a kind of a must in your portfolio. Okay, and it also gives you, the resilient business also give you a good combination of, sometimes there will be some dividends and then the equal amount of capital gain as well, right? But if you want to say that, okay, this sprinter business is always a bit higher risk because it depends on growth, and if they have evolved to a company big enough, they become a resilient business, which is the return will be kind of split between the capital gain, decent capital gain, and decent dividend yield. But if you want to go even lower risk, and you say that I want more consistency, because in modern day investment, it's not about a high return, it's also about consistency. So when it comes to this consistency, you might want to invest into what we call as the marathoner. Okay, it's like running a marathon, right? You're running a marathon for 3 hours. It doesn't make sense for you to sprint for the first 100 meters, because the only matters you want to sprint at the first at the last 500 meters or so, right? But for the first 40 km or so, you just want to do it slow and steady at a manageable pace. So in other words, this is how I would say this one is slow and steady kind of return. And the good thing about this, the volatility is less, which means that the price are quite steady. But they really excel in the dividend, right? They really excel in dividend yield, right? And this slow and steady, it is still growing, but it's not as fast as Sprinter, of course. But because the dividend, if you can get, for example, matching EPS of 6 or 7% of dividend per year, and then slowly it grows, over time it grows to, let's say, 8%, 9%, and all that, with almost guaranteed kind of consistency and predictability. So the expectation would be it will be still growing, but it will be growing at the same pace like your inflation rate or your economic rate, which is good enough, right? Which is good enough. So because they are very focused on dividend yield, and it's likely this company, they have the track record, or they're obligated to pay a high dividend payout. Like for example, if they earn 100 million, maybe they are going to pay out like 90 million or so of dividend. So it's like 90% of payout from their net profit and all that. And this is good because, you see, when it comes to a retail investor, when you want to invest, you already have a certain capital you invest in, a few millions, and what really concerns you during retirement, it's not about asset, it's about cash flow, right? You don't need the asset. If the asset doesn't generate enough cash flow, then the asset for any investment purpose is actually useless. What you want is the asset to invest in generate you the highest cash flow. And I think type number 3, the marathoner, is the one that can give you highest dividend payout, and in that sense, hard tangible cash flow into your pocket. And that's very important, right? Like one of the things that fit into this category is REIT, which is the what we call as a real estate investment trust, something that I specialize in. And if you want to join more details on what it reads about, why this is something I like, this is the marathoner, this is also the one that will give the most consistent and most predictable, give you least heart attack when it comes to investment return, no surprises. And likely, if you are new, this is also something that gives you certainty that it will not give you like nasty surprises in terms of price drop. That being said, it wouldn't also give you give you like suddenly the price go up 50%. Doesn't happen like that, but it just it doesn't make your heart jump. And that's good, because you don't, when as a new investor, you don't want to be traumatized by the sudden drop in price and whatnot. So if this interests you, just go to below here, reitmethod.com, or click on the description link or wherever you are seeing this, and join a free webinar web class I'm conducting every single week. So come back to here, and the fourth type that the company in wherever stock market and world that is what we call number 4, the seasonal. Now when it comes to this the seasonal kind, it is a bit dangerous because it depends very heavily on the rule of supply and demand. When there is more supply than demand, the price to go down. When there's more demand than supply, then the price actually goes up. So we are talking about some companies that deal with things like aluminium supplier, steel supplier, which are all the commodity supplier or company and all that. And that a mismatch in the supply and demand will cause the price to actually swing the other way, good and bad, right? And the other example I can give you is also oil and gas sector, because the price of the oil and gas sector is determined by what is in the world. Even though you are very well run company, you can't really set the price, right? There's a cost for you. Let's say if you are oil and gas refinery company, there's a cost for you to actually extract the oil and you sell it at the market. But how much margin you make from that depends on how much is the oil price at that point of time when you want to sell it. And this also a thing. Plantation stocks, right? Plantation like oil palm and all that, it also depend on how much or what's the price of the oil palm in the world for you to sell that. So your profit, your margin might swing the two other way, like wild swing. So your strategy, what is the strategy to actually play or invest in the seasonal stocks or business, is that timing is everything, right? Timing is everything. So it more or less, even though investment, you say you don't want to time the market because it's just full-time, useless. But in this, if you are investing in seasonal stocks or business, then you have to time the cycle directly. You have to enter at the right time and exit at the right time. So timing, you have to enter, you have to exit at the right time. This is very important, and it's likely you can only play this game well and win if you are already an insider. Let's say if you are someone who are in the oil and gas or oil palm industry, the what is going on in the business, so that is where you outperform other people, right? And because the cycle actually repeats, like there's a wave, there's an up cycle, there's a down cycle, and it's a bit unpredictable in terms of revenue, in terms of profit and cash flow. So it's like a bit of yo-yo. But some people like this kind of business to invest in because it gives you a sense of achievement. If you can achieve, they can time that well, and you lose their plans if you are not an insider and you cannot time your entry and exit well. Now, the final thing which I really do not recommend in investing is what we call redeem, because this carry the highest risk. This is the redeem is referring to previously loss-making company, not only 1 year or 1 quarter, but consistently making loss. They may be on the verge of they may be on the verge of bankruptcy, or what we call as in Malaysia, we call that PN17, creditor protection, right? Now this company is still not delisted yet, but they have PN17 some status. They say They have some turnaround plan in place, and that is why, you know, turnaround plan, you need a drastic, most of the time you need a drastic turnaround plan in place. You need a drastic change in the strategy, business model, or management. Okay, let me actually write this for you. The Redeem is a company that is on the verge of turnaround. You need a drastic change in the management, drastic change in the business model or strategy in order for it to actually improve their books. And then you just have to pick up at the lowest point, but not lower, you know. And but there's still no guarantee. You might have, you know, your total loss, you know, they might get delisted. And I only recommend this if you are the owner, if you have a stake in this company, something that you can control and you have a say to turn that around. If not, you'll be just an investor sitting on the sideline but not able to do anything productive. You just sit and wait. Now this is the helplessness that most people face when they want to play this kind of redeem stocks or counter, right? So the most safest one, number 3 in red, the marathoner, and then you might want to consider the second one, which is what we call the resilient, and then the sprinter. The more ambitious one, you want to speculate a bit, you want to test your luck, maybe you go to the seasonal business or counters. Now, the other analogy I want to actually share with you is this. Now imagine if you ask me like, Leo, what are the business or investment nature out of these 5 that I prefer? I can tell you by this kind of analogy. Now you see that this is the credit card analogy I want to share with you. And you know that credit card, there are, every time you swipe your card, right, there are 2 parties that actually make money, right? One make it long term, make it money short term, right? But in this sense, the short term is nothing bad. It's just that every time you swipe your card, the payment networks actually make money. Okay, so we say that this one is make money, this one also actually makes money, but this makes much more money. I'll explain why and how. So your payment networks, it is your Visa, MasterCard, and also American Express, which we call it as Amex. Now, how much does this payment network earns? So every time you swipe your card, these payment networks, a majority of the portion, we are talking about 1.5% to actually 2.5% in general from your transaction value, and this is applicable for Visa and MasterCard, right? And then you know that Amex, why does Amex, not every shops or not every merchant actually accept Amex? Is because the transaction fees are actually higher, which can go up to 3.5% of the transaction value. So you buy something 100 ringgit, Amex actually earn like 3 ringgit 50 cents. Now compared to Visa, Master, they earn like ringgit 50 or to 2 ringgit or so. So this Visa, Master, as soon as you swipe your card, they are earning, and this is actually pretty certain, which is pretty guaranteed, right? And almost sure there's no downside to it, right? This company make money is like they really make money in their sleep. There are no downside, right? There are no downside to it. As long as you swipe, you use the card, there's no downside. They make the money. That being said, okay, there's also no upside because they normally don't make more than the transaction fee itself. But one thing for sure, there is this extreme, right? Let me extreme consistency, even though you know the percentage was small. Now compared to this, right, compared to the second option, the banks, right? Now some banks also make some money from here, but not much. But you know that banks, they are more like a gambler, because bank earn the most money by charging interest on outstanding amount. So you know that for a credit card, as you accrue a certain outstanding amount, let's say 10,000, all right? Now, you have like a 20 days interest free, right? Interest free. After 20 days, you actually need to pay this 10,000 off. If you pay this 10,000 off, there is no interest charge. But if you do not, let's say you only pay like 4,000. So what's going to happen was the balance was 6,000 balance, all right? And you know that on a per year basis, the banks actually charge you an 18% interest on your 6,000 balance. Now, if on the following month, okay, hold on. On the following month, if you par it down to 3,000 outstanding balance, they are still going to charge you 18% per year on an annualized basis on the 3,000 outstanding. So if you say only 1 month divided by 12, there you go. It should be around like I think 1.5%, right? Out of this, that is how the bank make money. So the longer you actually overdue, the higher the amount was overdue, that is bank make money, which is actually, as you can see, 18%, right? We are talking about 18% here, and we are only talking about up to like 3.5% here. So we are talking about around 5 to 6 times more. So it's crazy. So banks actually bank on the hope to say that within 20 days you don't settle the full amount, so they are going to make like 5x to 10x compared to the transaction fees, which is actually charged over here. Now, if you are someone, so the bank, it could be on the both spectrum. So if bank is dealing with a customer like me, so can they actually earn this 5 to 6% of the transaction fee, which is equivalent to 18% per year? No, it's a big no, because I settle my balance almost all on time within 20 days after I have that transaction. So banks earn nothing from me. Even like sometimes they may be like even losing money because they need to give you a cash rebate and all that. So if you're dealing with customer like me, they earn zero. But bank is banking on the hope to say that customer who always have an outstanding balance, that is where they make money from these customers, likely maybe you. And they also they bank on their customer for any late payment, because in the terms of agreement, terms and condition, there's also a late payment fees, right? That is how they make their money. So now why I'm telling you all this, okay, all this is that the way banks makes money from credit card is very uncertain, because depending on the type of customer they're dealing with. On the one end of the spectrum, customer who pay in full on time, they earn zero, or they even loss making. But majority of people, the banks know this psychologically. They know that majority of people will have outstanding balance. Majority of the people will have late, will maybe a certain percentage will have late payment, and that's why they have this penalty. That's how they make the money. But it depends a lot on what? It depends a lot on whether they can make this kind of money. It depends on a lot of humans' habits, which is again uncertain. But if they can predict that well, it's something like a seasonal kind of stocks or investment, right? As you can see, I'm going to show you here again. You can see that it's more like a seasonal kind of thing, right? I mean, if you time it right, you pick your right kind of people, then you can actually make money. But if I were to run a business, right? I would rather, I'm okay with having this guarantee money making machine, even though it's only a few percent, because it's guaranteed, there's no risk, rather than to run this kind of bank model whereby most of the money is made based on banking on human habits, banking on most of the consumer have late payment, most of the consumer don't settle their balance in full, and most of the consumer, to the worst, they might even default and not able to pay even a single cent, and bank have to write that off, right? Of course, bank can blacklist these people, but still, because credit card is a unsecured loan, right? unsecured loan. What is unsecured loan or unsecured credit? Because there's no collateral. So you use your credit card, you don't charge your asset, you don't, like, you know, put your FD money, you don't put your house car as a collateral, which is why if they really cannot cover the amount owed, that become a bad debt that they would have to write off. So that is the risk over here. So they are dealing with very bad consumer, and they could actually lose the entire amount. So that is not a model I want to be. Although for a bank to actually have this prediction and have this model, you have to manage this well and not give a lot of, you know, approved credit card from people who have a bad repayment history or bad credit to actually manage their risk. If not, there will be a lot of default and bank will be losing money in their credit card business, even though they are charging like what 18% a year, which is 5 or 6 times more than like 1.5 to 3.5%, which I would rather want this to be. I would rather run this payment network business like Visa, Mastercard, and Amex. Which is why if you ask me, Liu, CF Liu, what is the one that I prefer? I always prefer the marathoner, because I know I have the ability to earn that kind of capital, generate that kind of return. I don't need that kind of capital gain from my investment, because I can use my high income skill to actually generate money for myself, put it into something which is the marathon, grow slow and steady, very consistent. Just like payment networks, I can contend with less if it's so guaranteed and so consistent, instead of putting into like redeem or, you know, the sprinter and all that. So it's not only the, like I say, it's not only the uncertainty for a bank business, the kind of model. It's not only in investment, it's not only the uncertainty and the risk dealing with, you know, humans' habit. And, you know, investment is basically also human emotion. Who make the buy and sell transaction? Human. But, you know, I better want to, you know, kind of ignore and remove that kind of uncertainty from my equation, like whether I want to evaluate whether a good paymaster or not, because people change. If you're a good paymaster today, doesn't mean that you will be a good paymaster in the future. So I don't want to keep on playing the game of, you know, cat and mouse. So what I want to do is that, you know, instead of losing my pants over here in the bank business, I would rather have this kind of business, right? I don't want my profit, my revenue tied to human emotion, human habit is so fallible. Which is why, to answer your question of what are the kind of business I always want to invest into, what I recommend is all about the marathoner here. So that being said, I hope this scribble on my virtual whiteboard has been useful. It has been give you a lot of perspective of how to go forward with this. So again, free web class, click on the links below. Here, go to reitmethod.com if you have time. And that being said, click on subscribe, hit the notification bell so you get notified when I publish lesson like that. Comments below if you have any, let me know what you think. And click on like if this has been useful. And I will see you in the next lesson. And this is CF Liu.